Yo, what up, everybody? Let's start off. Big Vic, what's the exciting news, brother? Give it to me. What is it? It's rate cut day. Let me make sure everything's coming in crystal clear over here. There we go. Nice and sharp. How we doing? It's rate cut day. Your boy's getting to grad school. Nice, Vic. Nice. What are you going to grad school for, might I ask? Obligatory cam pop. It's the FOMC rate cut day. We're going to cover the FOMC lead up of events, all the talking heads. We're going to get into the press conference, which should not be that exhilarating. And of course, we're going to look at the Q&A portion of the FOMC meeting, where the most of the value is going to come from. You've covered this. We've covered this in previous shows. You've heard me say it time and time again that is where all of this is happening. MBA and accounting, Vic, you stud. If I can go back in time and do that one, do one all over again, I think an accounting designation or CPA would probably be the most useful thing. And my son said, "Hey, Dad, what's the most useful thing I can learn in school today?" It would probably be accounting, because so many CFOs have that as their background. It's a path forward in every business, no matter what business you run. You understand the accounting side of it. You can understand how to move the dials in to really take advantage of it, which is, ironically, one of the only things that was positive that I learned from private equity, is that a lot of people in that space are really good at looking at numbers, but they're not really good at looking at people. So if you got both skills, brother, you're going to crush it. As always, this show is brought to you by the team over at Fridays. You see them down below. If you go to joinfridays.com, enter the code HIGHER, you get $100 off your first order. You'll help us, we'll help you. Longevity, everything from GLP-1 to NAD+, which I am actually on myself. And it's good for you. 24 minutes to the FOMC conference. As per previous shows, we're going to go into the live show a little bit, and we're going to look at stuff like this. For example, we're going to see the talking heads.
I don't know a fan, but yeah, we're definitely weakening, I would say, making lower highs, lower lows over the last couple of weeks. And we're coming into some pretty key levels.
But before we do any of that, what we're going to really focus on materially here in the show is we're going to focus on the current state of the market before we jump heavily into the talking headspace. Again, 24 minutes until the press conference happens. I will keep an eye on this in real time so you don't miss anything. Let's jump into the market status for today. Leading into this, we're back into a defensive hiding and safety position. Very volatile. We told you that's what it was going to be for some time. A lot of the conversation coming from J.D. Vance's speech this morning and some of the actions the White House is taking seems to suggest that this current kerfuffle in the Middle East is going to last for a lot longer than people expected, certainly weeks, if not months, which is why you're seeing meaningful changes in how we're handling tariffs internationally and the White House's rhetoric outside of that. Keep in mind, this bar down here will tell you the status of the market at all times. While we jump back and forth to what's currently going on in the talking head space, this will be a much more interactive show than previous shows. Synthetic volatility index. This is our version of the VIX, tells you the fear. We've got increased fear in the markets. Again, I think that's largely in response to the fact that a lot of the headlines, which had led us to believe that the status in the Middle East had gotten resolved, had gotten better, have not meaningfully improved the actual situation there. And because of that, the market's starting to realize that volatility. And of course, I would be remiss if I did not add, we got a world-class shit PPI print this morning showing that inflation, the producer price index, is rising well more than expectations. So naturally, any pressure that would have been on the Fed to reduce rates is gone. We're going to jump into liquidity position. This is the Fed's liquidity position. We're in a tense position. This has actually improved a little bit over the course of the last couple of weeks. The Fed is not going to change this in the next days and weeks. Frankly, you're not going to see any rate cut possibility. Fed Watch Now tool has it at a near 100% probability of no rate cut. Myron will be the only dissenting opinion here. And historically speaking, when an FOMC member dissents, that usually meant that there was a chorus of opinions and some collegial conversations that were happening. I think Myron just always dissents because that's his political allegiances, frankly. But you're going to see, again, all this pop up in the next, call it 20 minutes, and we'll watch through it. The affordability index has improved a tiny bit from strained and stretched here, but we're not seeing a whole lot of rate pressure. As a matter of fact, the 10 years are not improved. The 10-year treasury is not moving significantly in my mind. So you're going to see continued downside risk in the markets for the real estate market. I think there's trouble brewing here that a lot of this narrative around things like the mortgage lock-in effect, which I bought into too, and I think the idea that the supply issue is more meaningful than it actually is, were all false narratives on some level. The best laid plans of mice and men, but I think the reality is the mortgage rate environment is just one where we've driven up home prices to a point that they're not sustainable at this level. Home prices need to come down, and you could argue that's a function of supply and demand, but I would argue in a highly regulated environment, there's a much more nuanced answer to that. The sectors we're going to spend some time in jumping into here today, obviously with the pressure that we're seeing in the 10-year in the market and the constant and persistent push of possibility of war, this is not a meaningfully improving space because it is rate-sensitive demand. So D.R. Horton, Lennar, Toll Brothers, Pulte Group, all of them are down for the day. I expect that to be a common theme up and down as volatility spikes. I do have on my screen over here on the right, the 10-year popped up, and CNBC going at all times. What I'm going to do here is I'm going to jump back and forth when they're in commercials and when they're not in commercials. But for right now, I do want to spend some time covering the large data points before we jump too far into the press conference. So you guys all have a baseline of where the market is heading into the FOMC conversation. So right now, the things that I tend to look at, I always look at the bond market. I look at the 10-year. 10 years up today. This is putting upward pressure on mortgage rates. 10 years at a 4.228, up about 26 or so basis points. So again, not a huge meaningful increase. When you look at this on the one-day spectrum, it's up, right? That's driving the pressure on the home builder side here. And you've seen a pretty palpable uptick in this space over here on the right. And this is what is continuing to put pressure on the mortgage business. I'm going to go ahead and zoom there. That right there is your mortgage rate increase. I do expect this to continue to stay elevated for the foreseeable future until there is some relief in the war efforts or some narrative there that'll help the overall narrative in the markets. Let's go back to the cover of CNBC. One of the things I want to point out here, crypto down a little tiny bit. Typically speaking, when people have a flight to safety, you would see this grow, not decrease. So there's been a lot of volatility in this space. It's definitely back above 70,000, which I think is a meaningful number for crypto, but it is not meaningfully improved. The surprise for me here is that gold is actually down a little bit from its high. So that's a bit of a surprise to me, given where everybody was at before. I think if we have a persistent war effort or escalation of wartime situations, you'll see this number rise. I'm going to go back to the forecast and the sector section here. There we go. Some of you have asked why I haven't spent more time on the forecast and the modeling. That is coming. We're doing here in the background is we're building an alpha, which is our trading platform based off of how we look at the markets, both Kalshi, poly markets, and of course the stock market and real-time data. More on that to come. We gave you a bit of a teaser of what those forecast models look like, but certainly a lot of really fun stuff to come and share with you along the way. Good morning. Yo, what up, Saeed? Yeah, it is in fact Fed rate cut day. Thank you for all of us joining on Instagram. This one will be a little bit of a longer show, so buckle in. I'm just trying to get everything paced nice and clean up front, back and forth a little bit while we get into the commercials. Let's get into sectors. So we have a space there. Here we go. The banking sector next. Banking sector is all largely up. You've seen some good prints from them from a earnings perspective. CRE, commercial real estate, continues to be somewhat mixed. Nothing meaningful there. Mega cap actually down today, which is a bit surprising given some of the stuff that we heard from Nvidia yesterday. But again, kind of a mixed day. We're also in that defensive risk-off position, so be aware of that. The consumer staples I have long believed in. I continue to believe in them. They're all down today. I think this is because the PPI sentiment was so negative. It's dragging the market down. Let's get into CNBC for a little bit and see what the talk is.
Demand. That's right, Kelly. So we do follow Brent WTI so closely because they are the international
HIPAA.
and U.S. benchmarks with a lot of liquidity. But to show the extent of the current disruption, it's helpful to look at Middle East crudes. Both Dubai and Oman Blend have now surged and are trading at over $150 on the spot market. That's according to Platts, significantly above Brent, around 103, and WTI at 96. That's as of yesterday. And these prices are helpful to look at because it's not a market of speculators. The spot prices are for true buyers and sellers of crude. And CIBC Private Wealth's Rebecca Babin said that this is a clear warning sign from the physical market.
Yeah.
Dubai is acting as a leading indicator of where broader prices could move if disruptions persist and inventory draws start to spread globally rather than remaining regionally constrained. On the product side, heating oil future is adding another 5% today as diesel prices in the U.S. top $5 per gallon for the first time since 2022. Jet fuel prices hitting records. The Middle East accounts for about 6 million barrels per day of refined product exports, and Asian refiners now don't have access to the usual flow of oil from the region, further tightening markets. And as you said, Kelly, Egypt now, cutting their electricity use, showing the real world impacts of these price surges.
And $3.84 at the pump here. And you mentioned earlier on that we had some pipeline inflation kind of going into this. Do you think now are we just tracking with the price of WTI pretty much? Or I hope we're not tracking with the price of Middle Eastern crude.
Definitely not with Middle Eastern crude, given that we do refine a lot of the gasoline that we use in the U.S., although we do import gasoline on both the East and West coasts. But I think the trend higher is certainly higher, but maybe a slower move higher. We had that initial surge from that backup that we had to get with to match up with RBOB futures. But Kelly, prices are not going down here. So while there aren't as wild swings, the trend is certainly higher. And $4.
Yeah, and so that's interesting. We're all getting kind of an education on how the oil platforms worked in ways we probably didn't all understand when this whole war broke out. But certainly you're seeing a set of circumstances where you are seeing persistently higher oil prices, which will trickle down to the U.S. a little bit more than we've seen. I use WTI crude as my proxy for the oil market, but there's certainly other areas where you can look at for that detail. But certainly that is a reoccurring trend here. Let me get off while we have commercials here and get back to our sector analysis. I think as time goes by, you're going to see crude continue to increase because there's a material difference in what's happening in the Middle East right now and in the Asian markets to what's happening in the United States. But I don't think that people understand that this boon of Venezuelan oil, which is largely in the jungle, is not easy to get to. It's not easy to refine, and a lot of those factories are going to have a lot of work ahead of them. So if the expectation, what up, Rosie, was to that oil prices to come down near term, I don't see that happening. And as a matter of fact, you're seeing the pressure in the Middle Eastern oil markets continue to rise now. That will have impacts to our economy eventually. And there's something to be said for the fact that the PPI index came out today. So I'm going to go ahead and pull a little bit of that up for the headline news to share with you guys too before I continue on to the sectors. So U.S. Producer Price Index for February 2026 rose 0.7 over the previous month, more than doubling the expectation of 0.3% increase. That's a big number, according to the Bureau of Labor Statistics. On a 12-month basis, headline PPI increase of 3.4%, surpassing the 2.9% gain in January and signaling stubborn inflation pressures. So long story short here is that the Producer Price Index is effectively saying that inflation is in fact going the other way as an early warning sign. So a lot of what we're seeing in the markets and the sectors is certainly warned. Yeah, Rosie, we're a little early today because we have the FOMC conference. We're also going to go a little longer today than we normally would, just because I want to encapsulate that into the show. What I'm trying to do is during the commercial breaks, break you down the markets, let you guys see where the market's at and what the status looks like before we kind of tap into the FOMC conference and have a prolonged view on what's going on there. So the idea is to give you our normalized show content, status of the market, but hop back and forth to the FOMC. And if that bothers anybody, you can write all complaints to Saeed at higherstandardpodcast.com. All right, let's get back into our sectors a little bit before I jump back into it. Actually, hold on a second. Let me get some comments. It's been a little while, but this one's actually interesting. So before I do that, let's go over here. Velocity and Adventure. What up, my guy? Showing up early to the show. $3.84 at the pump. I wish I was paying that. $6.39 a gallon for diesel anywhere near me. And in some parts of California, $8. It was about a week ago. So yeah, that's more what I'm seeing. I agree with you. I don't know where the lower oil prices are coming in today, but sometimes you look at these national metrics that CNBC reports on, and you're like, what world do you guys live in? That's just not a reality. But having firsthand experience with the guys and the girls on CNBC, I can tell you that there's a pretty big disconnect in reality with them and everybody else. Let's get back to the rhetoric on CNBC for a little bit, and we'll jump back into the rest of the market sectors as the show goes on.
Have soared 30%, and they're sitting near record highs. Bank of America writing in a new note today that the increases in both fuel and fertilizer could mean 20 to 30% upside in corn prices, 15 to 20% in wheat. That's the base case now.
Yeah.
Let's bring in Peter Galbo, talk about what that means for the staples names he covers. He's senior consumer analyst, staples analyst at B of A.
I didn't know this was going to impact fertilizer. That was completely new to me, but fertilizer obviously trickles down to food, right? Crazy.
Month on month in the price of fruits and vegetables. I have no idea if that's immigration related. That's just one theory. It's a big month on month move. With the same time we have a strike at a meat packing plant, at the same time you're telling me that corn and wheat prices could go up 20%, at the same time that my delivery service just emailed and said the price of yogurt is going up 33%. So I'm like, what? Is there a common thread behind all of this?
Yeah, hey, Kelly. I don't know about a common thread of all of those factors. I think as you start thinking about, what we wrote in terms of grain prices and the impact that could have, that's probably the most discrete item. Particularly if we start to see $6 or $7 corn, and we're a ways off, I think, from the summer when we'll really know the true outcome. But if that's the case, think about what corn goes into as a feed cost for things like meat, particularly in chicken. And so that's probably where you're going to see it show up first, if in actuality that's kind of what ends up flowing through.
So in other words, when you say that corn prices could go up 20%, you're also saying that chicken prices could too.
Huh.
Typically what happens in an instance when corn prices go up is that the chicken producers will pull back, that the economics are not as favorable on a per chicken basis, and so you see supply start to get constrained, and that's when you can see an increase in price, basically to compensate.
I did not see a per chicken basis conversation taking place in the show today, but I'm here for it.
Like corn and soybean, right? And we have a plethora of soybean as well, so that can help offset some of it. But that's typically how you see the flow through on the protein side.
Back in 2022, 2021, the whole COVID era, we had tons of liquidity sloshing around, and all the price hikes were passed right on along to consumers who paid them and are still stunned by the numbers they're seeing. This time around is a little different, as I understand it. How much of these price increases do you think are going to be passed along, and how much is going to fall on the companies to take it out of their profit margin?
It's going to us.
Well,
Yeah, seriously?
Kelly, think about the number of companies that are talking about price investments, and we've just gone through that cycle over the past few months of some of the largest food companies talking about having to actually reduce prices. So are they really about to go out to consumers, roll prices back, and then kind of come back a month later and say, hey, actually, we have to come back and increase them?
Yes, they are. Yes.
They've worked too hard to try and get their price points in the right spot, I think, to do that, kind of suddenly.
Yeah,
that's great news. I mean, it's not great news. This might explain why the consumer staple stocks have been under such pressure, Peter. But what you're saying is that the consumer staples companies have been focused actually on decreasing price. We've seen this with Pepsi and these other companies talking about price cuts for the first time in years now. And now they're being hit by a supply chain issue. So they're saying we're just going to eat that, basically?
Probably still too early to tell, but I think if you look at what happened in 21, 22, 23, Kelly, you had the confluence of exiting COVID, kind of stock up demand, and then you had an inflation super cycle in terms of grain costs moving up. It's a different scenario this time around. Again, we'll see. It's a little bit different than Ukraine. Again, Ukraine was a really big exporter of grains and still is a very big exporter of grains. And so that's what threw the grain markets kind of into haywire at that point. With this conflict, yes, there are derivative effects and things like fertilizer that could eventually be passed through, but it's probably not as parabolic a move as what you saw in 22 and 23.
Yeah, quickly, I'm just going to rattle off some of, correct any of these if they're wrong. You still a buy on Mondelez, Smucker, Coca-Cola, a couple of beverage names, Monster, Celsius.
Nod your head, boy.
You like Utz. You like Once Upon a Farm. So Jennifer Garner will be fine. A little bit more cautious on Conagra, Kraft Heinz. Am I kind of capturing it? Tyson Foods.
That's right, Kelly. I mean, and those concerns are probably more top line driven, with an inability to.
So he's basically saying that the same staples that we follow on the show that we've told everybody are going to be the defensive positions in a market like this are continuing to be a market and an investment. KO, Coca-Cola, which we talked about in the last show, it still remains to be a good, solid investment. I don't see prices coming down. I see them continuing to stay up. The whole fertilizer, chicken, corn stock thing, all of that was completely just off my radar, admittedly, whenever we got into this. So it was a huge shock to me to see that, frankly, because I just didn't understand the global economy that well. And maybe I'm learning as we go a little bit, but that was surprising to me. Let's look at the industrials. The industrials are actually up slightly in the day, but incremental. And energy continues to be one of those sectors that we also feel very strongly in. It seems to show resilience through all this stuff. Even with the oil crisis and what's happening in Dubai, these companies continue to seem to make more money. So for all I can tell you is we really believe in the consumer staples, the defensive stocks. This is our version of what he's talking about in the staples. We call them capital preservation moves. They're all down today. I think that's just expected based on what the economy's at with the producer price index leading the way there. The PPI, the producer price index, is a meaningful challenge to a lot of people with the inflation perspective. But certainly if you're the FOMC and you sat down yesterday and you had your initial round of meetings in the day, and then you sat down today, you thought, okay, we got a good handle on things, and then wham, the PPI comes out this morning with a more than double the expectation. And that's because, look, I hate to say it, wars are inflationary. The casualty of wars are inflationary. This is government spending, okay? GDP will be propped up by this, but you're going to have a lot of inflation in the process. So I think JP Morgan Chase was the first person to call it out, saying no rate cuts this year as their kind of baseline forecast, with the rate increase of 25 basis points in early 2027. And that's shaping up to be more and more like that. A lot of the Europe in general, and a lot of other countries have actually looked at rate increases, not decreases, in the last several months. So I think that's not too distant a possibility. I know Myron's going to dissent here today. He's going to say he wanted at least 25, not a 50 basis point rate cut. But I don't know how you get there based on all the macro data that's coming in and a lot of these lagging indicators. I don't see this wartime effort. We saw J.D. Vance earlier today giving a speech that suggested that the pain points are going to be here at the pump. Well, the pain points are at the pump. Those things trickle down. We just heard fertilizer. We just heard corn. We just heard chicken. So the producer price index is kind of that initial barometer, but you're going to see CPI. Now, core CPI, which removes food and energy from that, will remove some of those elements, but certainly you're going to have inflation rising here in the not too distant future. So I don't know that you're going to get a rate cut per se. I think the Fed's going to be patient. And Jerome Powell might get a longer stay than May based on what's going on here. He seems to be pretty defiant in that regard. It's going to be a wild couple of months for sure. And I don't know if there's anything we can do to really change that narrative. Let's get into the breaking news, shall we?
I'm Kelly Evans alongside Dom Chu this afternoon, who is in for Brian Sullivan, as we are
Brian
just
Sullivan.
about 4 minutes away from the Federal Reserve's decision, its next move on interest rates. The odds of a rate cut are less than 1%. The market is basically expecting no action this meeting, but the path of future cuts will certainly be in focus. And it's Chair Powell's penultimate Dom press conference as head of the Fed. Ahead of it, here's how your money and markets are setting up. Scores on the doors, maybe they would call this. The Dow is down 442. The S&P is down 42. The Nasdaq's down 138, and the small caps are down 15. Bond yields, the last check was about 422 on the 10-year and 371 Dom on the 2-year.
That's going to push rates up higher today.
Of course, the big mover, Kelly, these days has to be in the oil markets right now. U.S. benchmark West Texas Intermediate WTI prices, you can see $96.52. It's up 1/3 by the way, and that is way off the session highs at this point right now. World benchmark Brent crude went as high as $109.95. on pace for its highest settle since July of 2022. Both are up roughly 50% since the conflict in Iran began. So keep an eye on those oil prices. The U.S. dollar, by the way, up fractionally today, just about 0.25%, trading just below that psychologically important 100 level. The greenback strengthening against major currency pairs, up 2% in the month of March. And the latest read on the AI trade, by the way, let's go microeconomic here.
Really?
Micron
Right now?
reports quarterly results after the closing bell. Shares hit a record intraday high just today. They've soared more than 350% in the last year as a supply shortage pushes memory prices higher. So this is where we begin.
Mentioned that. The Micron app, if you had to go only Micron or only Fed, Micron would be up there.
It would be, because it would set the narrative. We kind of know what to not expect or what to expect around Iran.
Yeah.
We do not yet know if that AI trade still has legs, and if Micron tells that tale, it could be big. Well, let's get right to the all-star panel we have assembled, as Kelly points out, are just minutes away from that Fed decision. Joining us now, David Kelly of J.P. Morgan, Jim Caron of Morgan Stanley, Tim Urbanowitz of
Kelly,
Innovator
my boy.
Capital, ETFs, and Sarah Malik of Nuveen. Thank you all for being here right now. I'll start with the bigger question right now first for David, because I'm staring right across the table at you. The Fed is not expected to do anything. Should it do something?
No, I think rates are at an appropriate level for where we are right now. I think there's a lot of uncertainty. I think what Jay Powell is going to talk about is uncertainty on both sides of their mandate. The thing that I'm going to be looking at mostly is what do they think inflation is going to be like this year? Because they're going to have to put some number down there. We're going to get their economic forecasts. So will they actually raise that from 2.4% at the end of the year, which is what they thought back in December, given what's going on with oil prices?
Jim, the commentary is key. So many people have already said it on our air today. People all over Wall Street are saying it. What kind of commentary would you be looking for?
So for me, I'm going to focus on their growth outlook, right? So inflation, we know it could be a transitory shock. We have a temporary, potentially temporary spike in oil. Ultimately, what is this? When does this? Where's the tipping point? Does this tip into from an inflation shock into a growth shock? I want to hear what the Fed has to say about that.
Yeah.
So I'm going to be really focused on what their growth numbers are and how they're actually interpreting this.
And Sarah, the risks out there are fairly evident with regard to the geopolitical ones. But some of the other ones around the macroeconomic story in the U.S. here are nuanced because of the many factors affecting it right now.
Sarah,
what's going to be the most important thing that the Fed has to watch for in your mind vis-a-vis all of those externalities being brought to bear?
Well, we're going to be watching the developments from geopolitical issues with the war.
Sarah going remote with a meh camera and AirPods and an echoey room for this? Come on, Sarah, step it up.
Came in sub 1%. And what are their views on the employment market? Now, the bulls and the dovish members on the Fed are going to say inflation's here today, but slower economic growth is here tomorrow. We can still get 1 or 2 rate cuts into the books later this year. Markets are currently predicting only 86% chance of 1 rate cut in December 2026. Yeah. Of course, the hawks on the Fed are going to say that inflation is now here and it's chronic and we can't cut rates or maybe even raise rates sometime this year.
I don't know if we can show this in the next 5 seconds. Kalshi's odds for the next Fed hike, 60% before 2028, 37 before 27. Steve Leisman has the decision.
Steve, let's go, buddy.
Unchanged. Federal Reserve leaving interest rates unchanged at a range of 3.5 to 3.75. It was an 11-to-1 vote with Fed Governor Steve Myron again dissenting, preferring to cut rates by 1/4 point. The Fed saying very up high in its statement today that the implications of developments in the Middle East for the U.S. economy are uncertain. But other than that, pretty robust or actually positive economic outlook. It continues to say, as it did last time, that the economy or the economic activity is moving at a solid pace. Say job gains have been low, but the unemployment rate is little changed. Now, as for the outlook, still 1 cut built in this year for the median Fed official, bringing the rates down to 3.4, and 1 cut for next year, another additional cut for next year at 3.1%. The long run, something that's been ticking up over time. The long-run neutral rate is now at 3.1. That is up 1/10. On inflation, the median Fed official now looking for 2.7 on headline inflation. That's from 2.4 in the December forecast. going back down to 2.2% in 2027. On core, looking for 2.7, up from 2.5, so 0.2 added there. Interestingly, GDP actually taking a tick up to 2.4 from 2.3 and 2.3 from 2% in 2027. So not seeing much of a GDP hit from the higher inflation forecast that is now part of the outlook. As for the dots, 7 officials want to hold, 12 want to cut. At least 1 cut or more. 5 of those want 2 cuts or more. The old range, guys, was a funds rate from, if you take all 19, the bottom was 2.1, the top was 3.9. It's come in a little tighter. Now it's 2.6 to 3.6. So a little bit of give on the dovish side, a little bit of give on the hawkish side, and now you have a little bit more centered around this 2.6 to 3.6 area. But again, the Federal Reserve emphasizing uncertainty. Interestingly, I would point out the idea that they upped their inflation forecast, but also they upped their GDP forecast. So that's kind of telling you perhaps where the center of the board is on the ultimate impact of the oil price shock. Guys?
All right, Steve, stick around here, please, because we have markets that are relatively stable right now, maybe not unexpected. We're all waiting for the press conference. Let's get out to Chicago for the reaction in the bond markets right now. Rick Santelli has that story. Rick.
Yes, Dom, if we look at all the intraday moves, 2s, 10s, and dollar index, what jumps out at me right off the bat is that the fixed income markets, 2s, 10s, the whole curve, we started to see yields drop even before anything was read at straight up 2 o'clock Eastern. So investors were buying treasuries in front of the statement, and after the statement, it had just a minor follow-through. We're at 370 in a 2-year before anything was read. We're at 269 now. We're at 421.
Because it was 100% probability the markets aren't surprised.
So you're correct. Not a lot of movement in the markets. But let's put a face on this. If we look at where we've been, on the 12th of this month, we saw 2-year yields at 3.74. The high yield close going back to August of 25. And if you looked at 10s on the 13th, they had 428. A high yield close for the move post-conflict, but they couldn't even take out their 429 high yield close earlier in the year in January. So really what we're seeing here is the 2-year yields seem most sensitive to the notion that we're not going to potentially get any more rate cuts, but that didn't change today. That's been the way it's been moving, flattening the yield curve, which, by the way, hasn't really moved much in the last couple of hours. And ultimately, the dollar index, well, the dollar index is up on the day. It was up on the day. It gave up a few ticks, but hardly at all. We've had a couple of bouts over 100, which is very unusual. We hit 100.36 on the 13th. That was a high watermark all the way to May of 25. So to summarize, listen, the conflict is an awful thing from a humanity standpoint. From the market standpoint, especially treasuries, it's been mostly well-behaved, obviously higher interest rates, but maybe the poster child for how it's dealt with this is that the 10-year couldn't even get a higher yield close than pre-conflict. And, of course, the dollar index, I'm not sure it's a flight to safety. I think it's more a function of the ECB. We're talking about our central bank. ECB tomorrow, most likely they're going to be looking at aggressive tightening because the energy situation outside of the U.S., whether Europe or Asia, is changing all the dynamics on potential inflation and central bank activity. Back to you.
Thank you, Rick. Just want to turn to the panel here, David, for some reaction. It's amazing. The statement, this is almost the most unchanged I've seen a pair of statements. The January to March one had virtually no change whatsoever, despite saying the situation in the Middle East is uncertain.
Well, yeah, because the uncertainty is on both sides. I mean, they've changed their growth forecast, they've changed their inflation forecast. I'm not surprised by what they've done here, but I do think there are two things. One, I think both numbers are now too high. I actually think that if we get some sort of stabilization in Iran, I think we're going to have to, in the course of a few weeks, then oil flows, and then I think inflation by the end of this year will be below 2.7. But I also think that it is ambitious to say that we're going to be over 2% growth next year if we don't have any further fiscal stimulus. And you've got this, this very tight labor market with the working age population is actually falling. You need to believe in a huge amount of AI productivity if you're going to get over 2% growth next year. So my guess is that eventually they pull both those numbers down, and that doesn't change rates outlook that much for this year. But maybe next year we do get some rate cuts if we go into next year with both growth and inflation falling below 2%.
Still in the cutting, I look at the price index. It's almost like, why do I bother looking? Does it matter? I'll let you jump in here, Jim. But you have a PCE that has gone from like 2.2 to 2.8 over the past 18 months while the Fed's been lowering rates. We're looking at 3% plus for CPI. We were at 3.1 for core PCE last month. Does it matter? I mean, I'm sort of like, if we're just ignoring all of this because there are downside risks to the economy, I'm struggling to kind of bring this all together.
So the way I look at this is, what's the read through to asset prices? So the question I asked before the meeting was, what's the Fed's view on an inflation shock versus a growth shock? The Fed just upgraded their view on growth. So what they're telling you is that this is a price shock right now, but it doesn't necessarily translate into a valuation shock because growth is still, based on what they're saying. And now, why did they say that? Is it because we had relatively strong momentum coming in and now we're in the middle of some type of a speed bump? And then do we get back on course? And I think that's maybe that's my look through in this. As I think about what the Fed has just said and what they've done with their upgrading and growth, is that they're telling you that valuations are going to be okay as long as growth stays relatively stable. That tells me as an investor that as we see a potential drawdown in markets, this might be an opportunity to buy once we get through this, providing the Fed's correct. Now, nobody knows how this whole thing's going to end, but it's really the difference between a price shock, temporary, versus a valuation shock, which has more permanence.
Even Waller, who had given that speech a few weeks ago where he said this is a one-off, the oil price shock that we're talking about, he did not dissent today. In other words, only Myron dissented for lower rates. Waller had dissented in January, but didn't do that anymore. So, like, if you were to say to the public,
because Waller thought he had a shot at being the next FOMC nominated chair. When Warsh was nominated, Waller went back to his normal voting pattern, knowing that his vote in the previous sentiment didn't really change anything. It was just rhetoric for potentially political campaigns.
It was actually transitory. 9% inflation didn't hang around, and this inflation won't hang around either after you get past oil and fiscal stimulus. If you've got divided government next year, you're not going to get fiscal stimulus. So they need some confidence in that, but eventually they're not that scared of inflation.
The 9% inflation was in June of 22, which is the month they started hiking by 75. You don't think that kind of
throttled it back?
Yeah.
No, because it didn't slow the economy. I mean, the transmission mechanism for rates, there's only one way they can kill inflation, that's by killing the economy. If they didn't kill the economy, then inflation fell, but they have the perfect alibi. It wasn't us, because we didn't kill the economy.
All right, so speaking of transmission mechanisms, I just want to bring one thing in here, because the asset prices Jim talked about is something, Tim, I know you watch it, because Innovator manages these funds and ETFs. Tim, I want to bring in the discussion here.
We got to get some of these.
Has there been anything surprising with regard to what's been happening in your mind geopolitically, in the markets, vis-a-vis oil, vis-a-vis rates, the Fed? The market seems to be taking it all in stride in a very orderly fashion, even if there has been a move lower from the record highs.
Well, Dom, I think we need to be cautious here of higher rates and how we're managing our portfolios. If you look across markets, you look at the oil futures curve, it's very clear the market is pricing this conflict in as temporary. We think that is our base case as well, but we also want to be careful because the reality of it is the longer oil prices stay at these elevated levels, the more of a chance we have where inflation becomes sticky. And that's not what we want to see. So we really want to be cautious about how we're managing portfolios right now, making sure we're preparing them for that threat of higher interest rates, the typical defensive playbook, whether you look at long duration bonds, defensive sectors. We don't think that works in this environment. So you have to be looking at other things. We think shortening duration on the bond allocation makes a lot of sense, shifting up in quality with our equity allocation, and then looking to more reliable alternatives like dual directional ETFs that give us the ability to generate a positive total return even if the market continues to sell off. We're seeing a lot of advisors implement that trade right now. We think it makes a lot of sense at this point.
Steve Leisman standing by down at the Fed. Steve, you want to jump in here?
Yeah, I want to tell you a story, Kelly, and I want to see if you believe this story. According to the futures market, Powell's going to leave his last meeting in April, 98% chance no cut. You get to June, ostensibly Kevin Warsh is the chair, 84% chance no cut. A little bit of the summer goes by, you get to the end of July, 69% chance no cut. Get to September, you come back from Jackson Hole, 54% chance no cut. It's not until you get to October and December of next year that you start getting an odds-on bet of a rate cut. That's the story the futures market's telling. I'm not sure I'm buying it. I guess it was David Kelly talking about the idea that maybe the market is a little too hawkish on the Fed. I think that might be right. If everything remains the same, I don't think it happens. Even if you get this possible surge in oil prices, I think somewhere along the way, the market is a little bit too hawkish on the outlook for the Fed. I'm not buying that story.
Okay, so I got a question then for Sarah about that. I would like to know, given what Steve just said, Sarah, in your thoughts,
here comes the echo chamber.
How much of that futures market pricing, that mechanism, the trading action that's going on there, is reflecting a handicapping of just how long the conflict in Iran goes for and what the lingering effects are? There has to be some kind of at least influence of what that's going to do to the rate picture over the course of the next 2, 3, 5, 6 months.
Well, that's the key question for the markets, because the longer that the war continues and the higher that oil prices stay, the more chronic inflation will become. What we've already seen with today's PPI numbers and recent inflation numbers is that disinflation had stalled. So we're not in an environment where disinflation is continuing. And now we have to worry about, is current oil-generated inflation going to be a one-time?
God, I can't stand her mic. Okay, so I don't like the constant positivity. It feels like we've all been in such a positive environment for so long. And look, I'm proud that we have been, that we've gotten disconnected to the realities of the market. Okay, I'm going to back this up a little bit here. There we are. I'm not to say that I don't want to be overwhelmingly negative. That's not my intention here. But what I am saying is that a lot of what we're seeing from them today seems to be this dissension amongst the ranks and how positive they want this all to be long term. I would argue that objective opinion of when the rate cut is likely to happen is out that long because the uncertainty that's out there. You've seen it in the VIX. You've seen it in our synthetic volatility index. You've seen that with a lot of indicators that there's a lot of uncertainty in the market. Elevated uncertainty means that there's going to be more confidence longer out than there is near term. It's just as simple as that. So yeah, I think that if there's going to be a rate cut, thinking out towards the back half of the year, or is probably a likely scenario for that. But what's going to get us there? I disagree with the narrative of the Fed around jobs. They said that they expect unemployment to stay at 4.4%. I don't. I expect it to rise. Sorry, I do. I don't think that they're fully understanding the AI hype and the intent of it. They're comparing it to what they've lived through most recently, and that being the dot-com bubble bursting in 2001, which was not a jobs displacement function. That was just an anecdotal side effect of that impact. AI is literally built to take jobs and replace functions that humans do. And sure, there's an argument that it can make you more productive, not less productive. You work more hours, not less hours. But certainly you're seeing a shift in the earliest of adopters. I would point no further than Meta and some of the rhetoric that we've seen around Meta in recent days and weeks about how they're looking to significantly reduce their workforce and change the way they manage people. If you manage 10, 12 people, you're going to possibly manage 50 in the future, leveraging AI. As a matter of fact, some of these companies come out so bold to say, if you're not using AI, that you are likely not going to continue to be employed there. They want to talk about it in every single meeting. And even Jamie Dimon has come out saying that that's a continuing, echoing thought through his management meetings where he's asking every single executive how they're leveraging AI to be more efficient. So I get why the efficiency play is there, but to ignore that level of institutional adoption and structure, and to ignore the layoffs we've seen early on from the earliest of adopters in the social media and tech sphere in Silicon Valley, to me points to a big disconnect still in jobs, employment, and where the FOMC likely could be towards the end of the year. I think if those numbers continue to spike, that's going to change the pressure. Again, the Fed having a dual mandate of jobs and stable pricing. We've been only really talking about stable pricing today, largely because of the impacts of the war, GDP, and the PPE numbers that came out, or PPI numbers that came out today. So keep that as a grain of salt. I think the jobs lever here could significantly change this rhetoric in the days and weeks to come. But right now, everyone's eye is off that ball.
I'm not seeing default risks meaningfully tick up in the credit markets. I'm not seeing earnings growth rates necessarily fall dramatically. Earnings growth rates are still pretty good. Earnings surprises are still expected to be good. So it's really a question of, again, how long does this oil, shock last, and what does it do to the growth outlook, which then how does that impact valuations? There's not a really clear picture right now in terms of how.
I would also disagree with that. I don't think what we're living through right now is an oil shock. I think it's easy to label this as a result of geopolitical conflict in the Middle East. But again, we had the Russia-Ukraine war, and now you've got the Strait of Hormuz that's being closed. You've got Israel and Palestine that's been going on for quite a lengthy period of time. And there's also conflict all over the world. So now you've got warships that are potentially surrounding Taiwan. So I disagree with the sentiment that this is geopolitical conflict driven and that it's just oil shock supply issues. I think that there is a material and meaningful change coming to the markets that we are now pointing the finger at the nearest, headline and saying this is what it is, because we've adopted this overwhelming sense of optimism in the market. So you can look, the war broke out, and the following Monday, the market popped up. It wasn't until Wednesday of that same week that you really saw the market accept that we're going to be in a prolonged, effort. And even yesterday and the day before, trading off the headline ideology that this could be ending sooner than expected, you saw things change. And this morning, when the White House made some political changes and J.D. Vance came out and gave a speech, which suggested longer weeks, if not months, of pain points for Americans as a result of this conflict, then you saw the market move the other way. So all this to say that there's this resounding, overwhelmingly positive kind of feeling and thought process that goes into things because we lived through 16 plus years of artificial interest rate deflation. We've had a lot more positive than negative times as of late. Even the bank contagion period of 2022 was short-lived relative to other market scenarios. So at some point in time, this has got to correct a little bit. That's just how market cycles work, right? It's up and down, up and down. And recently, what we've been experiencing is long ups and short downs and long ups and short downs. And that is not the way this has worked historically. Maybe with the information flow and traffic of information using social media and some of these things that the public sentiment can continue to carry positive news. But there's one thing about behavioral economics that we have to accept before we go much further here. And that's behavioral economics. Negative news carries quickly and goes away quickly until it becomes a news cycle, and then it's a parasitic cycle of negative news, negative news, negative news, negative news. Once we enter that cycle, those negative news cycle pundits will overwhelm the social narrative around everything else at some point in time. Let's go back to Steve Leisman here.
I think, though, that he's talking about a pre-2016 world in the sense that it's in that world that you could have a lot of global supply coming in and offsetting internal or domestic price pressures. But in a world of tariffs, there's less flexibility for global supply to address whatever deficits we may have on the goods side and address inflation. I would say this, though. I think that what the key to me is whether or not Fed officials are seeing this oil price impulse as a negative thing for growth or for inflation. And if it's on the growth side, then it matters what happens to jobs, most importantly. If it's on the inflation side, it matters what happens to core and inflation expectations, as well as trying to think of how they address it. There was a little bit on a hike before this statement came out. That bid is gone, and we'll see if that remains the case after Fed Chair Powell speaks.
Hey, Sarah, go ahead, Don.
No, I was going to say, Sarah, I was going to go to you anyway. One of the things that Jim brought up was we haven't seen a massive or significant revaluation of certain types of assets out there. But one place we have seen a relative amount of revaluation has been in places like private credit, like places like high yield debt, where we have seen prices come significantly lower over the course of the past 2 to 3 weeks, vis-a-vis what happened in certain equity parts of the market. Should we be worried that maybe that high yield collateralized loan obligation, private credit market is telling us something that the equity markets just aren't caught up to yet?
Well, it's something to watch. Now, first of all, in the private credit markets, that industry has evolved from fewer players to a whole lot of new players coming in. So this is part of the life cycle of an asset class over time. As more players have come in, they've had to go for lower deals, get into areas like software. So you do need to be aware and know what you own in private credit. If you're invested in areas where there's healthy exposure to software, given the AI risks, you could run into issues with that. But that's not I don't think it's a painted brush across all of private credit, because when you look at the sector as a whole, it's still fairly stable and high quality. Now, second, turning to equities, why have equities actually performed so well or not as bad as we thought they would during this geopolitical crisis? What we've seen is the typical buying the dip. So many flows, over $100 billion about a week ago, coming to the market from retail, target date, and foreign buyers. And why are they doing that? 2 reasons. 1, cash on the sideline to the tune of trillions of dollars. But 2, markets always assume that the Fed will come in and save the day with those rate cuts later this year if the economy slows.
What do you guys think, Jim?
Look, I mean, I think we have a pretty broad spectrum here. So one of the things that we were looking at coming into this whole Iran event was the market was broadening. It was a cyclical broadening. So there's a lot more things to start to look at. It's not just about the Mag 7. However, the Mag 7's actually done reasonably well over the past few days.
True.
So now we're starting to see some semblance of, well, if you were underweight, those Mag 7s, then, you didn't do so well over the past year, but you did, more recently. Now the cyclical broadening says that there are other things to buy. There are other quality places to go. So yes, you can be in investment grade credit. You can be in high quality bonds. You can also look for opportunities abroad outside of the U.S. into the European markets. There's a lot of different things that are going on, but I still think that the U.S. is going to come out of this the strongest, which is a little bit of a reversal because Europe did really well versus versus the
at
US.
least the medium term. Yes,
Yeah,
sure.
Because of oil, right? Because the U.S. now exports oil. So effectively, when I think about the ECB, you want to talk about probability of a rate hike.
They have two now that they're talking about.
They have two, exactly. And we're debating whether or not they cut
people say
one
this
or two
could be a
times.
huge error, a huge strategic error, just like they've made in 2008.
Of course it would be. The only way you can kill inflation is by killing growth if you're the central bank. Why would the European Central Bank? It's not like they've got this dynamic, booming economy.
But wait, David, can I just ask you a question? If the only way the central bank can kill inflation is by why do we even have them? In other words, isn't the purpose of the central bank on some level price stability, and isn't their tool interest rates? So if they see prices rising, shouldn't they raise interest rates as well?
No, because it doesn't really work in terms of slowing inflation. No, the central bank should focus on keeping interest rates at a fairly stable, sensible, long-term level. They should deal with financial crises, and they should not try and micromanage an economy that they are clearly not capable of micromanaging.
Single versus dual mandates, by the way, also.
In Europe, absolutely.
Yeah,
So that's
no
they
doubt
have
about
to
it.
respond, to that. But in the energy prices, but I can only imagine if they said, you know what? But we don't want them to make that mistake they've been making. Look how well their markets have been doing. Do you think it's over?
Interesting point there, and he brought it up. I don't know if you caught it or not, but the ECB, the European version of what I would call the Fed here, does not have a dual mandate. They're only concerned with price stability. So employment does not weigh on their decisions.
Or competitive or comparative, maybe comparative advantage is the right way to say it, relative to Europe, and everybody's kind of gone the other way. So I think it might be an interesting opportunity.
All right. Thank you all. Really, really appreciate it. Rick Santelli, Mike Santoli, Jim Karen, Sarah Malik. We're going to keep a couple of you guys around. We're just a few moments away from Chair Powell's press conference that begins at 2:30 Eastern time. Before that happens, a quick break and some final thoughts.
All right. So as we were covering the sectors, let's get on the calendar here for what comes up next. You got the 30-year mortgage rate, obviously the FOMC meeting today. Initial jobless claims tomorrow, which I think will be interesting. It would be really suck for the FOMC if they went super low. New home sales as well on the 25th of next week, but largely a pretty clear week ahead for data prints. I'm going to spend a little bit more time sending out data prints in some of our social channels. If you're watching X and Threads and LinkedIn, I'm going to be a little bit more thoughtful about how we structure and position those for you guys to see at some point in time because I think they're meaningful. Before we get the show started, look, we do have a chat going. That's all out there. You're more than welcome to pop in and make comments. These pull from everything except for Instagram because unfortunately Instagram doesn't play nice with the APIs. They want a contained ecosystem. I do bring those up on the screen. You are encouraged to chime in as we get into this part of the show. It should be a lot more fun. JP's going to come out, give his emotional farewell speech, kind of, second, I guess, to the farewell speech. And then he's going to answer the Q&A. The Q&A is going to be the most exciting part because there's going to be some bullshit and some shenanigans. And I expect him to be a little bit more Jerome Powell-ish, if you will. I want to use him as an adjective, than normal because he's going to be responding to a little bit of the narrative from the White House and the pressure that he got there. He got a big win. Sabas throwing bombs. Hell yeah. What up, my guy? Welcome, welcome, welcome. So let's see here who I got on the live stream over here from the other side of things. Sean in the hospital with a new baby. And yeah, bro. First of all, I love the fact that you're here. I can't believe it. That's kind of nuts to me. Yeah, and this comment right here, dude. Thank you, dude. I built all of this from hand. The infrastructure, everything else was vibe coded with AI. We got this coming. If you like what we're doing on the show now, you're going to really love what comes next because the live show has never really been about getting views as much as it's been an opportunity to engage with you guys, the core audience, as I like to call it, people who are the loyal kind of viewers of the show. But it's also been a testing ground for what we're building with our AI platform. And Said and I kind of went into it with a little bit of the unknown in the future. But now we've got so much data coming in and so many models being built that the next level of this is going to show you how we're leveraging everything that we talk about on a daily basis to make money. And that's a crazy thing to think about. Let's go through the headlines real quick while we're on commercial break. The Middle Eastern oil crisis, Iran continues to be the top of the headlines according to the trending topics on social media. Number two, obviously the Powell FOMC meeting anticipation going into this meeting. Social media sentiment around the analysis of Powell's opening words has become a contrarian indicator. Fade the initial reaction and focus on the policy and substance. So don't listen to all the drama. Stay focused on the detail. Commodities crash amid geopolitical chaos. This is because the White House made some comments today which seem to suggest that things are pivoting. Also, you kind of know the commodities implications based on the market and what's coming forward. Now, going to get back into the show here in a couple minutes, but the commodities thing is really fascinating. I really didn't know the myself. I didn't understand the fertilizer impacts. I didn't understand some of the other impacts as it relates to chicken, livestock, protein, poultry. I mean, it's just really fascinating how all this has a trickle-down effect. And it does leave you a little bit surprised that some of this stuff, I guess, isn't more inflationary near term. It's kind of a wait-and-see approach, but I guess we'll see. ECB is obviously one of the conversation points here. Rate hike expectation really caught people off guard. Markets are now fully pricing in a 25 basis point rate hike by the European Central Bank in 2026, which is what you heard them talking about here. ECB hiking expectations, according to AI analysis, in 2026, while the U.S. potentially cutting creates euro strength opportunity, considers European financials over U.S. peers. So really fascinating. And obviously there's an S&P technical breakdown here, which we can talk about a little bit after the show. I don't want to miss the start of the press conference. I'm going to go back over to CNBC here and we'll listen in on what's going on with the boys.
Pretty right or pretty wrong?
Well, Don, we had, prior to the war, we had this big capital rotation that was taking place. You had a shift into small caps, the S&P 500, equal weight, international. Those were all areas that were doing very well. And I think a lot of that had to do with the growth backdrop we saw and the idea that we were going to get Fed cuts in the back half of this year. Now, a lot of those have been priced out. That trade has been put on hold. We need those cuts to be priced back in to see that trade start working again.
Do you think that's true, that they're there, that one for one? Because that's exactly what Karen was just talking about, that he would now lean towards U.S. instead of, Europe or international.
Well, I think there's two ways to think about it. One way we're looking at this is if you continue to see the market pull back, where we start to see small cap selling off, equal weight index selling off, 5-10%, that's an area we want to step in and start nibbling, start adding some more of that. Because the reality of it is, if this conflict does wrap up, and it wraps up quickly, we start to see oil prices coming down. That backdrop is still very, very nice for stocks, and particularly those pockets of the market.
I mean, how did Trump put it?
I'll bet you $1,000 Jerome Powell comes out in a purple tie.
Yesterday from the
$1,000.
We did have this one dissent from Governor Myron.
$1,000.
David, he has talked a lot about how this just, to use your word, transitory or one-offs. Like he talks about the portfolio management.
That's right, but there's nothing wrong with an interest rate of 350 to 375. I mean, it's a myth to say.
David Kelly looked a little unusually kept this morning. He's usually very well buttoned together. I like him a great deal, so this is not a knock on him. And he's Irish, and I can't help but wonder if, because yesterday was St. Patrick's Day, if he had a little bit of fun last night, because this guy looks like he's fun to party with. I'm just going to be honest with you. And he was a little disheveled. He's certainly fixed his tie and his collar since the last cut to this cut, so somebody clearly put him on. But what a study he is. I don't think I've agreed with him as much today as I normally do. His sentiment is usually one that I tend to agree with, but his idea of possibly cutting rates and not seeing this as a permanent conflict situation, I think I disagree with. But again, he's smarter than I am, and I'm just an idiot on a podcast. But somebody told him to clean his tie up a little bit.
Your final thoughts here. What does the economy need to get for it to kick back up into real growth again?
Well, I think we want to start seeing those cuts priced back in. And I think it is going to be a hawkish pause today, but I think the market's going to look through that a little bit because they know we're getting Kevin Warsh here in July.
Here we go.
And the tone's going to be much different.
All right, here we go. Let's
go.
Fed Chair Jerome Powell taking the podium.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy has been expanding at a solid pace. While job gains have remained low, the unemployment rate has been little changed in recent months, and inflation remains somewhat elevated. Today, the FOMC decided to leave our policy rate unchanged. We see the current stance of monetary policy as appropriate to promote progress toward our maximum employment and 2% inflation goals. The implications of developments in the Middle East for the U.S. economy are uncertain. We will remain attentive to risks to both sides of our dual mandate. And I'll have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. In our summary of economic projections, the median participant projects that real GDP will rise 2.4% this year and 2.3% next year, somewhat stronger than projected in December. In the labor market, the unemployment rate was 4.4% in February and has changed little since late last summer. Job gains have remained low. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including job openings, layoffs, hiring, and nominal wage growth, generally show little change in recent months. In our SEP, the median projection of the unemployment rate is 4.4% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.8% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. Near-term measures of inflation expectations have risen in recent weeks, likely reflecting the substantial rise in oil prices caused by the supply disruptions in the Middle East. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 2.7% and 2.2% next year, a bit higher than projected in December. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5 to 3.75%. From last September through December, we lowered our policy rate 0.75 of a percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should continue to help stabilize the labor market while allowing inflation to resume its downward trend toward 2%. But the implications of events in the Middle East for the U.S. economy are uncertain. In the near term, higher energy prices will push up overall inflation, but it is too soon to know the scope and duration of the potential effects on the economy. We will continue to monitor the risks to both sides of our mandate. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of this year and 3.1% at the end of next year, unchanged from December. As is always the case, these individual forecasts are subject to uncertainty, and they are not a committee plan or decision. Monetary policy is not on a preset course, and we'll make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you, and I look forward to your questions.
Thank you. Colby Smith of the New York Times. There's been some debate about whether the Fed should look through the inflation that will come from higher oil prices stemming from the Middle East conflict. Is that the right approach at this juncture? And to what extent does the fact that inflation has been above target for roughly 5 years now influence the committee's thinking around this?
So, first, let me say we're well aware of the performance of inflation over the last few years and how a series of shocks have interrupted progress that we've made over time. And that happened most recently with tariffs, and now there will be some effects on inflation coming forward. The thing that's really important that we see this year is progress on inflation through a reduction in goods inflation as the one-time effects on prices of tariffs go through the system, go through the economy. That's the main thing we're looking for going into this exercise. And we need to be seeing that to sort of understand that we actually are making progress, because on net we didn't make progress. And if you look at total core inflation, it's about 3%, and some big chunk of that, between 1/2 and 3/4, is actually tariffs. So we're looking for progress on that. The question of whether we look through the energy inflation doesn't really arise until we have kind of checked that box. It, of course, is kind of standard learning that you look through energy shocks, but that's always been dependent on inflation expectations remaining well anchored. And I think now it's also dependent on what you mentioned, which is that broader context of 5 years now of inflation above target. We have to keep all of those things.
He's being a little dismissive in my mind of some material things in the market beyond just tariffs. Obviously, the geopolitical unrest, the oil, the trickle-down effect, stuff like that. But the energy stuff is normally dismissed by them anyway because they look at core PCI.
There is still a bias to cut for most officials this year, despite the upward revision to headline and core inflation and the essentially unchanged forecast for growth and unemployment. Just curious, kind of what's the genesis behind the need? What's the need for the cut?
Yeah, so, there are 19 people, and so 19 reasons, 19 individual submissions, but if you notice, the median didn't change, but there was actually some movement a meaningful amount of movement toward fewer cuts by people. So 4 or 5 people went from 2 to 1, let's say, 2 cuts to 1 cut. And each person has individual, stories behind what they want to do. But essentially it is that, the forecast is that we will be making progress on inflation. Not as much as we had hoped, but some progress on inflation. It should come as we start to see in the middle of the year progress on tariffs, going through once and then tariff inflation coming down. We should be seeing that. And, the rate forecast is conditional on the performance of the economy. So if we don't see that progress, then you won't see the rate cut.
Come on, Howard.
Thank you. Howard Schneider with Reuters. Just to follow up a little bit and to be clear, is the higher inflation penciled in here for 2026 solely the result of the oil shock or something else?
Tariffs, bro. Tariffs.
So that's going to be part of it. But, that wouldn't be most of core, right? So the oil shock for sure shows up here. Some of that will be in core as well. But yes, but no, there's also just the feeling that we haven't seen, the progress that we had hoped for on core goods and on tariffs and on the rest of it. So for whatever reason, people did write up their inflation forecast. That will certainly be tied to
spike midday
events in the Middle East and the price of oil. But it's also, I think, a reflection of the slow progress we've seen on tariffs, which we believe we will see. It's just a question of how long it takes for them to get all the way through the economy, and it just takes some time.
Right. And is the lack of change in the SEPs, again, just to explicate this a little bit, more due to the expectation that the oil portion of this will pass through, or more out of concern that there is a potential blow to consumption and growth coming in the form of wealth effects with the stock market down, in the form of gas prices, diverting spending from other parts of the economy?
So I didn't get the second part of your question.
The consumer is going to be potentially diverting money to gasoline from other parts of the economy. There could be a growth shock or a redistribution of spending there that can hit consumption, wealth effects as well. I guess I'm wondering, is the rate forecast not changing because you think the oil shock is going to be temporary, or because you want to be sure you're positioned in case growth starts to slow?
So the thing I really want to emphasize is that nobody knows. The economics effect could be bigger, they could be smaller, they could be much smaller or much bigger. We just don't know. So people are writing down something that seems to make sense to them, but have no conviction. To your point, if we have if we have a long period of much higher gas prices, that's going to weigh on consumption. That'll weigh on disposable personal income, and it'll weigh on consumption. But we don't know if that's going to happen. Something quite different than that. We might have much lower than expected pass-through. So people write down, this is one of those SEPs where a number of people mentioned if we were ever going to skip an SEP, this would be a good one, because we just don't know. So I wouldn't say there's a conviction that this is going to go through quickly or not quickly. It's just you got to write something down, and this is something that is that people wrote down. We don't debate how long. How do you do that? We wouldn't be able to debate what the length of or size of these effects would be. We just have to kind of make an individual statement. And also, what you've written down before you'll be reluctant to move too far away from that, just because you don't know. It's so unclear what the direction from this particular end will be. Meanwhile, the growth has been solid. And inflation, the overshoot is mainly from the goods and tariffs. And, the labor market is, the unemployment rate, of course, is little changed since September. You have a very, very low break-even rate, apparently, for new jobs, with little growth in either demand or supply. But the U.S. economy is doing, pretty well. It's just we don't know what the effects of this will be, and really no one does.
Mr. Chair, in the past, the staff has suggested that higher oil prices, they have a hit to consumption, which Howard was talking about, but that's somewhat offset by increases to domestic production. I wonder if you could talk about that dynamic, especially to the extent that how much U.S. production is happening right now.
So the first thing is there is, the original thinking, the long-standing thinking, put it that way, is that you do look through energy shocks. But as I mentioned, that's conditioned on inflation expectations and that kind of thing. So, your question was?
What the staff is saying about, and has said in the past.
Yeah. So there'll be an offset.
Offsets, yeah.
So that's true. We have, we're a net exporter of energy, right? So any effects on employment and economic activity and spending would be offset to some extent by the fact that our oil companies will be more profitable, and they may even do more drilling. If you ask oil companies about doing more drilling, though, they're going to want to see, a consistent rise in oil prices from where they were before the buildup for the war, and they're going to want to believe that that's going to be persistent for a fairly long time. So they're not sitting there waiting for oil to go over $70 a barrel, and then they're going to start drilling or whatever. They're going to make a reasoned, careful judgment that we're going to have higher oil prices for an extended period, meaningfully higher. So I wouldn't say.
You catch that? Oil companies aren't going to be producing much more until we have oil prices. They're going to control the oil price. So what he's basically saying, which is true, is that unless oil is persistently higher, these companies are not going to produce more oil to stop and stem this tide. So the reserve benefit that we're getting globally is going to go away when the reserves are tapped out and oil is not being produced at a higher volume.
That having looked through tariff inflation and inflation running above target, and looking through the oil price shock would undermine the credibility of your commitment to the 2% target.
We have to do our analysis and think these things through carefully. But of course, that's on everyone's mind. We're well aware of the history, but you don't want to overreact to that. You want to make the best judgment you can based on the facts. I don't think we're going to let it color our decision making more than is appropriate. It's more the thought that it's been 5 years, and we've actually had we had the tariff shock, we had the pandemic, and now we have an energy shock of some size and duration. We don't know what that's going to be, actually. And, it's one of those things where it's a repeated set of things, and you worry that that's the kind of thing that can can cause trouble for inflation expectations. And so we worry a lot about that, and we are very strongly committed to doing what it takes to keep inflation expectations anchored at 2%. And I think it's important that we do that. Very important.
Nick.
Nick Tamaros, Wall Street Journal. Chair Powell, you've described monetary policy as modestly restrictive. If the unemployment rate is roughly stable, inflation moving sideways in the high twos, with an ongoing overshoot in services and non-housing services, not just goods, and the economy doing fairly well, as you just outlined, what gives you confidence that inflation returns to target over the next couple of years?
Okay, so I would say the rate is, you can characterize it as in the high end of neutral, or you can characterize it as perhaps mildly restrictive, even modestly restrictive. No one knows for sure, but it's in that range where it's somewhere around the borderline between restrictive and not. Remember that a big part of the disinflation we're looking for is just the runoff of when tariffs are put into place. Of course, what they do is they raise prices to some extent, to the extent those prices the tariffs are paid by consumers on a one-time basis. And we're waiting for that process. It takes 8, 9, 10, 11 months, a year to go through the system. And we're waiting for the tariffs, which were put in place over the course of the middle part and later last year. We're waiting for that to go through the system so that goods inflation will return closer to what it's always been. I mean, it used to be, for many, many years, it was negative. And then, the year before tariffs came in, it was 0. And it's running at like 2% now. So, and so that's kind of, goods inflation is running at 2%. So that's not coming from standard Phillips curve restrictive, restrictive policy. It's coming from the runoff of a one-time thing. We also think it's important, though, to keep policy either mildly restrictive or close to that, but not too restrictive because of the weakness in the downside risk in the labor market. We are balancing these two goals in a situation where the risks to the labor market are to the downside, which would call for lower rates, and the risks to inflation are to the upside, which would call for higher rates or not cutting anyway. So we're in a difficult situation, and we feel like our framework calls on us to balance the risks. And we feel like where we are now, which is kind of on that borderline, the higher borderline of restrictive versus not restrictive, we feel like that's the right place to be.
Can I ask about core non-housing services, though? Because there are some people who think that it hasn't come down very much, if at all, over the past year. If wage growth has come down, if the labor market has loosened, why has non-housing services inflation maybe been slower to follow?
Home prices are too high, baby.
It's frustrating. Non-housing services they basically moved sideways for a year. They're at the same level.
Home prices are too high.
We do expect that they will come down, but it's a bunch of idiosyncratic things. But at the same time,
not really.
That is one of the things we should be seeing, because to your point, the labor market is clearly not a source of inflationary pressures, and that should really matter for non-housing services. But we're not seeing progress there. So we do, what we expect for next year is continued, what we want to see for this year, rather, is continued progress on housing services, finally seeing that, the goods inflation come back down because the one-time effects of tariffs are through, and then also get some help from non-housing services. That's what we'd like to see. But it's a good question why we didn't see much.
Or after any implications of after any implications of tariff stuff passes through, you have geopolitical unrest and oil impacts and inflationary impacts beyond that.
Numbers revised down to negative 17,000. January revised down. February posted a loss of 92,000. Is the employment side a far greater risk than the inflation side? Because we are seeing inflation. CPI is close to 2%. PCE has ticked down overall.
It's really, I wouldn't say that. I wouldn't say that that's clear at all, that one is more at risk than the other. So you can point to the unemployment rate being stable, and, in a world where both supply and demand for workers have come down very, very sharply over the course of the past year due to immigration policy largely, a ratio is going to be a better thing to look at than job creation, for example. So, and the ratio is the unemployment rate, and it's been stable since September. So that tells you that. Inflation, we're at 3.0% core. inflation 2.8% headline. So we've been well above the 2%, that amount, whatever it is, 0.7, 0.8, or a full percentage point above 2% for some time. And that's a concern. You know, we need to get back down to 2%. And we need to keep focused on that, even though we do now face some new inflation from energy. So I'd be hard-pressed to say that one of them is obviously more at risk than the other.
And if I may,
AI.
what happens if there's no Federal Reserve chairman confirmed on May 15th?
Yeah, baby.
So if my successor is not confirmed by the end of my term as chair, I would serve as chair pro tem until he is confirmed. That is what the law calls for. That's what we've done on several occasions, including involving me, and it's what we're going to do in this situation.
I called it on the show. Last episode, we told you.
On the question whether I will leave while the investigation is ongoing, I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality. And I would refer you to the statement that was in the Fed's brief that you all have seen, and I won't have anything more for you on that. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet. And I will make that decision based on what I think is best for the institution and for the people we serve. Figuring you probably were going to set the dominoes off there, Edward. And I'm not going to have any more to say on those issues, by the way.
Yeah. Yeah, good for you. Good for you, Jerome.
Thank you very much. Claire Jones from the Financial Times. People have drawn quite a few historical parallels with the current situation. We've seen oil price shocks in the past. Some people have said the first Gulf War and the Fed's response to that, where there was a focus on the growth risks, is the right parallel. To what extent would you agree with that, and to what extent do you think we're in a different place today? Thank you.
You know, it's really hard to say until we see the situation, the actual situation. In some circumstances, that might be the right case. In fact, for example, if we do see the kinds of disinflationary progress that we expect to see due to tariffs that I mentioned, I think it's hard to say, and it will depend to some extent on the size and duration of the effects we're seeing on prices, and it will depend a lot on what we can see in inflation expectations.
And just one follow-up, if I may, just on the BLS report that was mentioned briefly there. It doesn't seem from the projections or from the comments you've made today about the unemployment rate and focusing on that your view on the labour market story, to a large part being a supply-side story, has changed despite the quite negative number in February. Would that be the right take, and was there anyone else in the room who thought differently, and that the February jobs report was cause for concern?
So I think you have to take the two together. You know, in a way, the January report was a positive surprise, and the February report was a negative surprise. If you put them together,
they're bullshit.
You get something in the middle, and I think you have to really,
which
as
is
you do,
also
I'm sure,
known as bullshit.
There was a strike, and there was weather, and that's about 80,000
man.
Negative effect total on the February report.
92,000 jobs, poof, disappeared because of a fucking strike and weather?
There are a number of indicators that suggest a degree of stability, but the thing that I think a good number of people on the committee are concerned about is just a very, very low level of job creation. If you adjust what has been the trend job creation over the past, let's say, 6 months, if you adjust that for what we think, our staff thinks, is the overstatement due to overcounting, effectively there's zero net job creation in the private sector. But actually, that looks like that's about what the economy needs in terms of dealing with very, very low, non-existent, really, growth in the labor force, which, of course, we've never had in our history. So you've got a sort of a zero employment growth equilibrium. Now, that's balance, okay? But, you know, I would say it does have a feel of downside risk, and it's not kind of a really comfortable balance. So, you know, we look at that, we see it, we get it, and I mean, everybody understands the arithmetic, and that's you can say the break even is zero, but nonetheless, it's something we're watching carefully, and so and you know, are concerned about. But ultimately, though, you can argue that it's a consequence of deliberate policy, which is really the changes to immigration. That's the biggest factor there, and but nonetheless, something we watch carefully.
Thanks, Chair Powell. The economy's experienced a series of supply shocks in the last few years, COVID, tariffs, 2 oil price shocks. Do you think that is bad luck, or has something changed in the world that makes supply shocks more common? And does the central bank need to start taking account of the risk of supply shocks as a more common problem?
You know, we did go through a long period where the shocks were all demand shocks. And, you know, so we've had a lot of practice thinking about supply shocks in the last 4 or 5 years, for sure. And it's just a very different thing and a much more difficult thing, because it does immediately raise the question of tension between the 2 parts of our mandate. But, you know, has the world changed? I mean, COVID is a one-time thing, right? This energy supply shock is a one-time thing. It's not because of some broad tendency or anything, I don't think. And you know, the oil shock with Ukraine was also a consequence of military action. So I don't know that the world has changed in a way that there'll be more supply shocks. But you know, there's people have written that paper and that speech a number of times. A number of people have tried to make the case that that is the case. And in fact, we have seen more supply shocks in the last 5 years than we've seen in many years before that. It's a fact.
Okay. You said last year that the Fed was reviewing its communication strategies, including the SEP, as part of its framework review. Whatever happened to that? And I have like 5 follow-ups to that, but you know, I guess, you know, what would you change about Fed communications if you had the time? Thanks.
What happened about that was not much, and I'll tell you why. So, you know, we looked carefully at many aspects of the SEP and of our communications, and there weren't any ideas that had very broad support on the committee. And you don't want to make a change to your communications unless you have the committee behind that. So we didn't really make any changes on that. I had hoped that they had some things that I wanted to do, but they didn't attract broad support, and we'd already made all the changes we made to the framework. That was a critical thing. So we didn't. And, I wish we had been able to do some things, but you know, we didn't. So maybe the next chair will take a look. I'm sure he will.
Michael McKee from Bloomberg Television and Radio. The minutes show in January some members of the committee wanted to include a 2-sided guidance on policy. Was that discussed today? And given the rise in the inflation expectations, how much support for a 2-sided policy warning would there be?
So it did come up today. The possibility rather that our next move might be an increase did come up at the meeting, as it did at the last meeting. The vast majority of participants don't see that as their base case. And of course, we don't take things off the table. But you correctly characterized, what was in the minutes that several participants indicated, and something very much like that conversation did happen. What was your second question, though?
I was just one question there, but follow-up would be, there are a lot of goods besides oil that are trapped in the strait right now, and a lot of supply chains getting snarled. How much concern do you have about whether, if this becomes an inflation problem beyond just oil, whether there's anything you can do about it or would do about it, given the efficacies of monetary policy?
You know, you can worry about other commodities. You can worry about all of the ways that oil-related commodities go into manufacturing and that kind of thing. The truth is, it's completely out of our hands, and we just, like everybody else, we have to just wait and see what happens, and it'll come down to how long, the current situation lasts, and then what are the effects on prices, and then how do consumers react and that kind of thing. Really, I wouldn't speculate in any way, and there's really not a lot we can do other than kind of watch and see.
Maria Luisa. Afternoon, Chair Powell. Maria Luisa Capurro with Bloomberg News. I wanted to ask you, you've said longer-term measures of inflation expectations reflect confidence that the Fed will get back to its 2% goal, but there are some colleagues of yours who have pointed to higher dispersion in household service, in business services as well. So, and that they take as a signal that inflation expectations may be less sticky than in the past. I'm wondering if there was a discussion around that at this meeting across the committee, and what were the views of what is the state of inflation expectations and the risks from higher oil and gas prices.
So at this meeting, I mean, a number of people mentioned and staff briefed on short-term expectations having moved up quite a lot for reasons we understand well. But long-term expectations, you know, you can always find one that's troubling or some aspect of one that's troubling, but ultimately, right through this whole period, the overwhelming majority of the things we look to, including markets, including surveys of, you know, of the public and also of forecasters, they've all been pretty solid on longer-term inflation expectations being right where they need to be, consistent with 2%. So that continues to be the case. We didn't have a lot of conversation about that. I think everyone does agree that you know, we'll be watching those extremely carefully as we see the effects of the price increases come through from the conflict.
And still on how the discussion went across the committee, before coming to this meeting, there were some members who were like discussing the risks of a slowdown in growth and at a time of where inflation remains high. It really doesn't seem that most members are penciling in a slowdown in growth.
No.
But has there been any discussion of the risks of stagflation at this point?
So people actually wrote up their growth forecast by 1/10, and I think that's probably to do with just growing confidence in productivity. But sorry, and your second question was just.
If there have been any discussions about the risk of stagflation scenario.
Yeah, so as I mentioned, there is tension between the two goals, right? The upward risk for inflation and downward risk for employment. So, and that puts us in a different situation. You know, when we use the term stagflation, I always have to point out that was a 1970s term at a time when unemployment was in double figures and inflation was really high and the misery index was super high. Add them together, you get the misery index. And that's not the case right now. We actually have unemployment really close to longer run normal, and we have inflation that's, you know, 1 percentage point above that. So calling that stagflation.
What I missed?
Yeah, I would reserve the term stagflation for, you know, a much more serious set of circumstances. That is not the situation we're in. What we have is some tension between the goals, and we're trying to manage our way through it. It's a very difficult situation, but it's nothing like what they faced in the 1970s, and that's. I reserve stagflation for that, the word for that period. Maybe that's just me.
Elizabeth. Thanks so much. Elizabeth Schulze with ABC News. President Trump says that oil prices and overall inflation will go down very rapidly as soon as the war ends.
Yeah, that's not going to happen. Sorry about my little departure there. We have a very important guest coming on the show in the not too distant future. And when that guest comes on, we have a security detail that's going to be part of that. So I had to talk to the team who stopped by to check out the spot and make sure that everything was up to snuff. So my apologies for the departure. But if you need anything, I'm still here. What did I miss?
And should people be bracing for higher costs, including for food now?
We don't know how big these effects are going to be, and I don't want to characterize them in any way. Of course, people are already seeing gas prices. Gas prices are up almost $1 a gallon. We hope that isn't for a long period of time, and of course, people will feel that. But I don't want to speculate about what that might mean because. Honestly, that would sound like I have some idea of what's actually going to happen, and I don't think anybody really does. We're going to see how this works out, and I just would leave it at that.
Victoria.
Hi, Victoria Guido with Politico. I just wanted to ask, for purposes of the next meeting, you know, how the Middle East war develops between now and then, how are you thinking about what might guide action at your next meeting? I mean, if we have oil prices, you know, above $100 a barrel the entire time until the next meeting, is that going to change your wait and see stance? Like, what would lead you all to move, or are you on hold pretty indefinitely?
We'll have to wait and see. I mean, you know, we always say we're going to learn more by the next meeting. And usually we do, but in this case, we're going to learn a lot because we're going to learn 6 weeks to the day till the next meeting.
Yeah.
And
your last
you know,
one,
we're
boss.
going to see whether
Kinda.
what happens is it's going to be very important for the way the economy looks and the way the outlook evolves with what happens in the Middle East. That's going to be a big factor, and we'll know that then. I don't know how it's going to affect our thinking. I really don't. And we did talk about alternative scenarios a little bit, but it's just, I wouldn't bring that in here. It's very uncertain, and I just want to just remember that we don't know, and we shouldn't assume it's going to be one thing or another. We're going to see.
So is it a matter of you don't know how the situation itself is going to evolve,
Look at the
or
treasuries, all
even
up
if
today.
things remain as they are, the economy could still remain relatively durable in face of them?
Yeah, that's true too. No, I mean, the U.S. economy has just, made it's been strong through a whole bunch of challenges. I mean, if you go back to 2023 when we raised rates a lot in 22 and 23, and close to 100% of economists called for a recession, which didn't happen. In fact, 2023 was a really strong year. So the U.S. economy has really been just doing pretty well through a lot of significant challenges over the past few years. It's been amazing to see.
Yeah.
And I don't know what's going to happen in the next intermeeting cycle, and I don't know what's going to happen in the Middle East. I wouldn't want to speculate.
Good call, Chief. None of us do. Frankly, we don't even know who's alive or not.
Hi, Chair Powell. Thanks for taking our questions. What makes you so certain that tariff-related price increases will be a one-time effect? I don't think we've seen you since the Supreme Court tariff decision.
Yeah, that's right.
And it's pretty clear that none of us know what the extent of the tariff shock will be as the administration moves to replace some of the tariffs that were overturned. So
Good question.
I suppose I'm curious, what would make you question this certainty that tariffs are going to be a one-time price effect?
Well, I would not at all use the word certain about my views on that. I'm not certain. I'm uncertain. But just if you think about what it is, it's a one-time increase in the price of a good, right? And what inflation is ongoing increases in prices this year, next year, the year after. That's what inflation is. It's not a one-time price increase. There's a very, very big difference. The public doesn't really focus on that, but that's the difference. And tariffs should be in theory, unless they cause people to start expecting still more tariffs the next year and still more tariffs the next year, they should be a classic one-time thing. People say the same thing traditionally about an energy price spike, because traditionally prices go up and they come back down. And by the time monetary policy would react, it would be over. So I don't have tons of confidence on that. I think that the theory is probably right, but as usual, the time it takes to get all the way through the economy is just very uncertain. And we found that coming out of COVID, that the inflation did go away, and largely for the reasons we thought it would, but it took 2 years longer than we thought. So I think we have to be humble about knowing how long it will take for tariffs to go all the way through the economy. And so what we've been doing is our staff's been doing.
Be humble.
It's very interesting. They started off with just an estimate because there wasn't a real history, and then they've built based on the history that they're seeing of tariffs coming through into prices. They can now have an arc. And for all the tariffs, they can say, well, so we have, I think, a slightly more confidence that we will see tariff inflation coming down, not prices, but you won't see further increases. And we should start seeing that more and more in the middle parts of the year. We do expect that. Now, you're also right, though, that the level of tariffs came down fairly meaningfully in the wake of the court decision, but the administration said they're going to get that rate right back up to where it was. So, and we assume that they'll do that over time. So that's how we think about it.
Thank you.
Hi, thank you, Chris Rugaber at Associated Press. You talked about the shortcomings of the SCP in this environment. I wanted to ask about, or throw in an additional thing, which is the fact that it's happening before transition. Is there still some value, perhaps, in the public knowing what other Fed officials are thinking, the ones who will stay on for the rest of the year and beyond? And does that even handicap your successor in any way? Well, just in terms
That's
of
a weird-ass question.
Having a whole committee expressing its views
Look how confused Jerome looks right now. He's like, what the hell is this guy talking about?
No. We never. The SEP is never. People are more than happy to change their SEP dots. They're no way bound by them. You know, it's your opinion at a moment in time, which can change based on events. You know, sometimes very quickly. So it never locks people in. You know, people are more than happy to be proven wrong in either direction, and so I just think we do it. And you know, I mentioned this was a time when it's very hard to do it. During the pandemic, we actually took one meeting off, I think, but you know, we don't like to do that just because it's hard to do. We should just keep doing it. But I just would say for this one though, I think it's even more than usual good to take the forecast with a grain of salt because subject to just very high levels of uncertainty.
Hi, Chair Powell. Brian Chung with NBC News. So you mentioned at the beginning of this conversation that you're well aware of the history of inflation running above target. It seems like that might be what's underpinning the affordability problem that we're hearing a lot about on Main Street. Are there any signs to you that that's impacting the psychology of the consumer, especially given that they're a big driver of overall economic activity?
I'm not sure what that's all about, but I'll tell you what I think and what we see in surveys, and that is, you know, there were big price increases all around the world, by the way, everywhere in countries like the United States had basically the same kind of thing. It was a global inflation coming out of the pandemic, and everywhere people are feeling like real wages have been going up in the United States now for 3 years, roughly. But people are not feeling good about it yet, and it will take some years of positive, real earning gains for people to feel good again. We think, but you're right. When you talk to people, they do feel squeezed, and you know they're.
And he just said that he expects years for people to not feel squeezed.
Various different kinds of insurance are getting more and more expensive, and that's just catching up really from inflationary pressures that take a while to get to the price, price. So we take it very seriously. We don't dismiss it at all. It's a very real thing from the standpoint of what people are experiencing. And you know, what it does for us is, you know, makes us even more committed, if that's possible, to getting inflation back to 2% on a sustained basis.
How does the Fed's independence play into the ability to address affordability?
Well, independence is what allows us to do our jobs, and you know, stable prices is half of our mandate. It's one of our two mandates, maximum employment being the other. I mean, look at every advanced economy that looks anything like the United States, anywhere in the world, in a market economy, in a democracy, and you'll see, you know, pretty much central bank independence that looks a lot like, in some cases, stronger than what we have, but. It's critical that we have that so that we can do the things when we need to do them to preserve price stability. And it's an accepted standard practice, and I think has a lot of support, certainly in Congress, which is where our oversight is in Congress. And you see that among Democrats and Republicans in the House and the Senate.
Hi, Chair Powell. Richard Escobedo at CBS News. Thanks for doing this. Two questions. One, how high would oil prices and broader inflation have to go, and for how long, for the committee to consider hiking rates? And then secondly, diesel prices are rising faster than gas prices. How concerned are you that the increase in diesel might drive up food and goods prices and lead to broader inflation?
Yeah, I'm not going to give you an example or specific answer on the first question. You know, we're prepared to do what needs to be done, but I wouldn't want to hypothesize about what that might be. You know, in terms of diesel prices. So your question there is, are we concerned about it? I mean,
how concerned, and whether or not it will drive up, you know, the cost of food and other goods that really rely on it to.
So I think it's a more general concern than that. It's diesel prices because that's transportation of food and things like that. There are just lots of ways that oil and derivatives of oil get into the production and transportation of many things. So, and those, there are big effects in headline inflation, but things like that leak into core as well. And the effects may not be as big, but they're quite real and they're material. So we are aware of that, and we're watching it, but we're right at the beginning of this, and we don't know how big we just don't know how big this will be and how long it lasts. It may or may not be something that really makes a big imprint on the U.S. economy. We're just going to have to wait and see.
Thank you.
Archie, for the last question.
Oh, man, look at the Dow.
Thanks very much. Just to sort of stare into the future for a little bit, I was looking at the longer run bits of the SEP and noticed that the growth estimate had been revised up a good chunk from 1.8 to 2, and the kind of long-term Fed funds rate as well. It'd be great just to hear, is that AI productivity or what's going on there exactly?
Oh, an AI question.
Yeah, I think it's just productivity. We actually started seeing meaningfully higher productivity some years ago, 4 years ago, 5 years ago. And that's not because of generative AI. We won't know for years what it's really due to. But it could be due to the kind of things that people did during the pandemic.
Come on, Jerome.
Economize and somehow become more productive because there was an incredible labor shortage. But I think economic forecasters are very skeptical of periods of high productivity because they're so rare and they're often revised away. And for many of us, I never thought I'd see this many years of really high productivity, and by the way, expect it to continue. And we haven't really started to see the effects of generative AI, and that should certainly contribute to that. So
what?
It's quite unusual, and it's this is the higher productivity is the thing that allows incomes to rise over time, and so it's a great thing. Was that your question?
Yeah, no, I was just curious what lay behind that.
Higher productivity allows wages to increase over time. For employed people, you douche. No.
That should also weigh down inflation over time, maybe then kind of pull down where rates end up. Do you kind of agree with that line of thinking, or do you think that's not how you think about where the rates?
I think you have to be cautious about that, in particular if you're talking about AI, about generative AI. So remember, in the short term, what's happening is we're building data centers everywhere, and that's actually putting pressure on all kinds of goods and services that go into building these things. So that's actually probably pushing inflation up at the margin. In addition, it probably raises the neutral rate. So in the near term, you're not looking at something that would immediately call for lower rates or that would be lowering inflation. Over time, though, sure, it can be if it's expanding potential output, which is what higher productivity does, then it actually can be. But I think it's an empirical question because it's really is the demand growing faster or slower than the supply side? And I think we just don't know that answer ex ante going in. We'll just have to wait and see. Thank you very much.
Oh, God. Man, that's so frustrating.
Bell, that was Fed Chair Jerome Powell. No rate cut as expected. Stocks didn't initially react to that news, but look at the charts if you can. During Powell's remarks, the Dow dropped about 200 points from down 400 plus to down.
I'm just going to skip the whole market recap piece here from them. I'm going to give you some recaps that I have, frankly, from my own perspective. That was discouraging, to say the least. Okay, well, let's go to the quotes, shall we? This from the FOMC conference recap. Mirren was the only dissenting opinion. He wanted a 25 basis point rate cut. Fed unemployment forecasts remain unchanged at 4.4%. I think that is a material disconnect to reality. The non-AI conversation here is stunning. The Fed projects one rate cut this year and one cut next year. Continuing on, Jerome Powell's speech quotes that are material. He said in his speech that started off with, activity in the housing sector remains weak. Job gains have remained low. No comment regarding AI until the very end there, just immigration. He kept saying immigration. Inflation in the goods sector largely impacted by tariffs. I think it will be impacted by the oil shock as well. The FOMC recap continues with, if we don't see progress on inflation, then you won't see a rate cut. That's interesting. U.S. economy has been expanding at a solid pace, and he went on to say, while job gains have remained low, unemployment rate has been little unchanged. Again, I think this is AI here, not immigration. I think immigration does play an important part of this, of course. Inflation in the goods sector has been boosted by tariffs. Oh, we got my guy Siegel on the actual show here. Let's get back to the screen share and let's see what he has to say.
And he will until the suit is dropped. So in other words, the only way
Trump can get rid of Powell is by dropping the suit.
Yeah, that was sneaky.
Now he won't necessarily be chair. If
Right.
Tillis continues to say, I'm not going to confirm Warsh until the suit is dropped,
Yep.
then he will be chair under the rules of pro tem chair continues on. So I found that interesting. And by the way,
Aside from the palace intrigue of that, what do you view as being the policy impacts of Powell remaining connected to the Fed and active on the Fed over that period of time, should that come to pass?
Well, I was looking at the bond rate then, and I saw the yield start going up, and I'm saying, oh my God, does that mean, there's a general expectation that Warsh will be more friendly, obviously, to cuts. That's why Trump picked him. So
that's the
now
problem.
if Powell stays on, now I don't know
We got a 10-year.
if everyone understood that, doesn't necessarily mean he stays on as chair. But if he stays on, he's still a very influential voice, being chair for 8 years.
Yeah.
He could argue against those cuts. And, I'm not saying that's the only thing that I thought affected. I saw the 10-year go up 2-3 basis points. Now,
Yeah, so let's have that conversation. We called it on the last episode. If you haven't checked it out, it dropped last Tuesday, the Higher Standard podcast. We specifically laid out this scenario where Trump would come out, where Jerome Powell, Freudian slip, would come out defiant and say exactly what he said today as it relates to his positioning. He could be the chair pro tem, be in the seat longer. He effectively threatened Trump, saying that he's going to stay in that seat until that lawsuit is far in his past, basically saying, if you don't drop this suit, I'm not going anywhere. And he also knows that he has certain members of the House and the Senate saying that they're not going to confirm Warsh until such time, which would lead him to be continued in that position in the pro tem position. So really fascinating development there. I don't think any of the market activity that we saw necessarily, the 10-year and all that increasing, was a response to that. But fascinating conference. That one statement in and of itself is worth the watch and listening to my obnoxious return. I apologize for leaving you momentarily while I had a visitor come to the show. Thank you. It means a whole hell of a lot to Saeed now that you guys tuned in. All the comments, I try to engage as much as I can. It actually helps me out doing these shows like this as opposed to the normalized shows, because instead of me going constantly, we can actually watch somebody else talk and chat. So the next layer of the show will be bringing in guests via remote and obviously doing a little bit more fancy stuff with camera work over time. But thank you to everyone who tuned in. And this is your time. If you have any comments left on the table, get them out, because we're going to end this pretty shortly here. So again, you want to show the show some love, you can go to thspod.com, buy some merch. You'll buy that effectively really at our cost, but you'll share the show with your friends every time you wear the shirts like this. This is our seasonal all facts, no cap shirt. We also have a sponsorship brought to you by the lovely team over at Fridays. You can go to joinfridays.com, use code HIGHER, and get $100 off your first order. It does support the show, and it means a whole hell of a lot to Saeed and I and Rajil as well. Thank you for tuning in. Until next time, everybody, we'll catch you on the next Friday live at our normal time at 11 a.m. Pacific Standard Time. Okay, bye!